Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CUBESMART quarterly report. CUBESMART offers a range of businesses and services that cater to the needs of its customers. These include self-administered and self-managed real estate investment, trust ownership and management of 1532 self-storage properties across the United States, provision of affordable storage space for residential and commercial customers, climate-controlled storage facilities, in most locations innovative solutions to simplify organizational and logistical challenges, unparalleled service, and genuine care for its customers. CUBESMART's stock price has dropped by 17.53% in the past year due to a combination of disappointing quarterly earnings reports and broader challenges within the self-storage and real estate markets. The company's struggles can be attributed to several key factors, including disappointing earnings per share (EPS) forecasts in Q3 2025, with an EPS of $0.36 falling short of the $0.38 forecast. Declining same-store revenues year-over-year and negative same-store net operating income (NOI) growth in Q3 2025. Decreasing net income attributable to common shareholders and a decline in same-store NOI in Q2 2025. A slight miss on Wall Street expectations for both EPS and revenue in Q4 2024, leading to a stock decline of 2.95%. The self-storage market has faced ongoing challenges, including declining occupancy and increased operating expenses, which have impacted CUBESMART's performance. Analysts predict further declines in profit margins over the next 3 years due to margin pressure and slower growth. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, an increase in the number of stores and leasing available self-storage cubes to new customers contribute significantly to revenue expansion. Maintaining and increasing pricing levels, managing rental rates and occupancy levels, and additional revenues from newly acquired or opened stores also play crucial roles. On the decline side, economic conditions in the real estate industry, competition from existing and new self-storage properties, consumer impacts due to inflation, tariffs, rising interest rates, and wage stagnation all contribute to revenue decline. Additionally, availability and costs of external sources of capital can hinder growth. Interestingly, an increase in average outstanding debt balance and higher interest rates also impact revenue growth or decline. However, the net proceeds from unsecured senior notes issued during a specific period can mitigate these effects. Overall, a delicate balance between these factors determines the company's revenue trajectory. Net income and profit margins decline. A summary: the company's net income has decreased significantly over the past year. For the 3 months ended September 30, 2025, net income dropped by $18,534 compared to the same period in 2024. This decline continued for the 9 months ended September 30, 2025, with a decrease of $36,401, 12.6%. Profit margins also suffered, with operating margin decreasing from 54.2% in Q3 2024 to 38.6% in Q3 2025, and from 36.3% in YTD 2024 to 30.1% in YTD 2025. Net income as a percentage of total revenues also declined, from 37.1% in 2024 to 28.9% for the 3 months ended September 30, 2025. The reasons behind this decline are multifaceted. A decrease in equity earnings from real estate ventures and an increase in depreciation and amortization expenses contributed to the net income drop. Additionally, accretion of fair market value adjustments on debt and higher net interest expenses likely had a negative impact on profit margins. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the financial summary, the company has consistently produced positive operating cash flow in recent years, as stated on page 19. This is a significant indicator of the company's financial health and stability. The consistent generation of positive operating cash flow suggests that the company is effectively managing its resources and generating sufficient revenue to cover its operational expenses. The company's debt level has experienced a significant increase over the past year. The carrying value of mortgage loans and notes payable rose from $2.99 billion at December 31, 2024 to $3.43 billion at September 30, 2025. Additionally, the average outstanding debt balance increased from $2.94 billion in 2024 to $3.44 billion in 2025. In terms of interest expenses, there has been a notable increase. Interest expense on loans rose from -$22.75 million in 2024 to -$29.38 million in 2025, representing a 28.9% increase. Furthermore, cash paid for interest, net of interest capitalized, increased from $77.95 million in 2024 to $90.29 million in 2025. Overall, the company's debt level and interest expenses have changed significantly over the past year, with both experiencing notable increases. Management is focused on maximizing revenues through strategic rental rate management and occupancy level optimization. They aim to drive internal growth while selectively pursuing targeted acquisitions and developments. The company's self-storage properties are seen as relatively resilient to economic downturns, but prolonged recessions could impact cash flows. Management expects to access various capital sources, including debt and equity, to fund their long-term liquidity needs, ensuring they have adequate resources to execute their business plan. The company's financial summary reveals a commitment to rewarding its shareholders. Specifically, it has paid dividends in both 2025 and 2024, indicating a consistent practice of returning value to its investors. This demonstrates a focus on shareholder satisfaction and loyalty. Concerns about inventory buildup and supply chain disruption. The company's financial summary reveals concerns about inventory buildup. The increase in storage properties from $6,038,186 to $6,377,973 indicates a significant accumulation of inventory. Furthermore, the decrease in additions and improvements to storage properties suggests that the company may be struggling to manage its inventory effectively. This buildup could potentially lead to supply chain disruptions if not addressed promptly. Excess inventory can tie up capital, increase storage costs, and reduce flexibility in responding to changing market demands. The company must reassess its inventory management strategies to mitigate these risks and ensure a smooth supply chain operation. That concludes the financial summary for CUBESMART. Feel free to comment below, and I will be happy to answer them when possible.